All right, hello everybody. Good evening. Welcome to tonight's session on what's hot in Singapore with our guest today, Willie Keng of Dividend Titans. Now I
Hello.
know that our background is still in daylight mode because this is actually a pre-recorded session. But don't worry, you can ask those questions in the comment section. Then Willie will be able to answer your questions later. All right. So let me just introduce Willie a little bit. This is our guest today on What's Hot in Singapore, and the topic that we're going to discuss today is about the rising interest rates and how it would affect stock market. Right. So Willie is a CFA charter holder or certified financial analyst, and is the founder of Dividend Titans. At dividendtitan.com, we'll put in the comment section so you can check him out on the website, right? It's actually a financial publication for investors who are doing themselves to grow their wealth safely. And Willie has also worked as a research analyst in quite a number of financial institutions. So he has quite a really strong background in doing research work. And some of the institutions are like Deutsche Bank, Bank of Singapore, and even DBS Private Bank. And he was also in Phillip Capital Management, where he also helped manage one of the biggest retail Singapore dollar money market funds, right? And Willie also runs a business consulting firm, and he advises family offices and also investment firms. And you can also see Willie in the mainstream media. I think it's been on Investor One, Dollar Sense, Sidley, and Investing Note. And he has also been invited to many different conferences like the REIT Symposium in 2021, and he's also been interviewed by Money FM 89.3. And lately, he's also been a moderator for one of the largest online conference in Singapore called the Singapore Trading Festival. In fact, this weekend, the festival will still be on. We'll provide the link in the comment section so that you can register and sign up, where you can find Willie and also communicate with him over there, and also with other speakers as well. So do head on to the link. It's actually at sgtradingfestival.com, right? So click on the link on the comment once we have put it up there. Willie, thank you so much for joining us today.
Thank you, Benny. Hello, everyone.
Yeah, so we have actually have quite a number of speakers before this, including our regular one is Jeff Harvey from SGX. But we want different people to come in, and Willie will be one of the person that is able to share with us in this particular topic, right? So again, guys, if you have any questions, you can just type in the comment. This is just going to be a presentation style, right? So, I mean, it's going to be the interview forum style. So there's no presentation slides or whatsoever. But the topic we really want to cover is basically, I think everybody is concerned about rising interest rates. And the impression that people have is, it's always negatively correlated with the stock market, right? When interest rates rise. But is that the case, right? So that's why we want to basically get Willie to give his opinion. And before that, right, whatever that's being shared today, okay, is for educational purposes only. All right, it's not intended as any investment advice. If you do want to look for investment advice, please do look for a licensed and professional investment advisor. All right. Okay. So Willie, we know that the interest rates has already been expected to increase this year, and recently the U.S. Federal Reserve has just raised its target for short-term interest rates in the latest FOMC meeting, right? With 25 basis points, so it's gone up from 0.25% to 0.5 or 0.5%. And a lot of analysts also do forecasts and predictions that they're probably going to raise the interest rates up to 1.5 to 2.25% by the end of this year. And that translates to about probably 7 to 8 times in 2022. But what do you think? Do you think this is viable in your opinion?
Yeah, I think that's a very good starting question, Benny. I think it's hard for me to answer, number one, because it's very hard to predict where the market is going in terms of raising the interest rates. I think even the Fed themselves, I think they are pretty uncertain exactly how much they're going to raise, because I think they're also trying to see new economic data which is coming out, and you are also having like very strong labor employment, So it's a growing economy, and inflation is also rising. So there is a lot of moving parts here. So it's very, very difficult to actually have exactly how to predict exactly how much rates are going to go up by. But what I can say is that the impact of increasing rates too much is it can be political suicide for the US economy. Number one, because if you can see right now, the amount of federal debt which the US is paying in terms of the interest, is roughly about $300 billion, and that's based on the interest rates of about 1+%. And if they actually increase it, to about 2+, more than 2+%, it's going to actually double the amount of interest which they're paying on their debt, and that's going to amount to close to about $600 billion, and that's already close to the amount of defense budget which they're paying for defense. So it is going to be very challenging for them. If they're really going to be very aggressive in rates, it's also going to be something which they have to manage. And I find it tough, that rates going up would actually go back to where it was in the 1980s, where it will be double-digit interest rates. I think that's going to be very difficult to go back up. I think some form of increment, that there will be some form of rise, but I don't think it will go just aggressively high. Yeah.
Yeah, I think we also said this. I mean, previously, if you still remember, during the subprime mortgage crisis, when the stock market fell like crazy, and of course there was quantitative easing in 2009, right? And when the market recovered in 2013, this is the same thing that they said they're gonna taper down, they're gonna cut. I mean, they're gonna raise interest rates because it's growing, but that did not happen. Right? I think they just wait and see, by raising interest rate and see how the market reacts and increase again. So do you think that will happen again?
It possibly could. I mean, it really depends. If let's say a couple of things, right? If let's say housing prices would really go skyrocket, and if it is a repeat of the subprime era, then of course possibly that will actually happen. But in this case, Benny, I think this is a really we are in a much different environment, where a lot of the demand is really driven by a disruption in the supply chain. That's one, and you really have the digital revolution coming in. So I think that explains the pull in the general economy, especially in the US, which we are seeing.
Yeah, like you said, I mean, there are many different moving parts that are going to affect the decision of these policymakers, right? And of course, in 2009, or even in 2013, when they said they wanted to raise the interest rates, but at the time inflation was still manageable, right? It's still quite low. But right now we are looking at inflation going up the roof. It's like going back to the 1980s level. So do you think that's a pressure for them to actually raise interest rates to buffer that inflation a little bit now?
Yeah, I mean, possibly, Benny. I mean, if we see in the 1980s, inflation really skyrocketed, and really that's because the US actually went into a different, turbocharged mode, right? It was at a stage where its industries were growing really, really fast, and as a result, back then, the Federal Reserve Chairman Paul Volcker had no choice but to increase rates, to about double digits. So at one point, it was about 15 to about 18%. Will today go back to will today's environment really repeat? In the 1980s, it's hard to say. I personally don't think so. Number one, like I've mentioned, if they will actually increase rates to double digit, the government could actually shoot themselves in the foot, because then they will actually be paying a huge amount of interest, and that will actually leave the US even more heavily indebted. So I think that's one thing which they are actually very cautious about. And don't forget, this year the US is also facing their midterm elections, and that's something which they're also very careful. If they are too aggressive in raising rates, I think that might not be too it might not paint a very beautiful picture when it comes to the midterm elections. I think people generally like to see a much more supportive policies coming from the government with regards to their economy.
Right, right. So now let's move back to Singapore, right? So where do you see in Singapore in terms of this monetary policy? Do you think that interest rates would be raised in Singapore as well?
So it's actually a very interesting thing which you have mentioned, because in Singapore, our interest rates are sort of pulled along by global environment, global influences, especially in the US, because we have a huge trade, a huge exposure to the US market. So if interest rates go up, naturally, Singapore's interest rates will get pulled along with it, right? So how the central bank, how MAS actually controls or manages our monetary policy is we basically focus or manage our Sing dollar currencies against the other currencies. So we manage it by trying to appreciate the Singapore dollar or trying to depreciate it. And in this instance, as regards to rising interest rates in the US, there could be also a gradual increase in Singapore interest rates. And MAS is also aware of that. So what they do is also they are also trying to appreciate the Singapore dollar so as to sort of cool down or slow down the economy or the rising inflation which is coming.
Right, right. So it's yeah, I think because maybe a little bit different from Malaysia, lah, right? Because Malaysia is mostly domestically driven, but Singapore is more like the Asian financial hub, right? Or at least Southeast Asian financial hub, lah. There is always a an impression that rising interest rates would actually benefit banks. I mean, we have seen actually Singapore banks perform really, really good, ever since that pullback from the start of the pandemic, right? And prices of banking stocks have gone historical high. So, do you think it's because of these interest rates that the banks are performing better, or are there any other factors that affect the bank's performance?
Yeah, this is one good question. So I think theoretically interest rates are very good for banks because, as you can see, right, if let's say interest rates go up, banks can charge more on the money which they lend out to. So, say for example, in a rising interest rate environment, the mortgage payment which we pay on our property goes up. So that's more profits for the banks. And it's good because high interest rates this way, they can charge higher. And at the same time, the deposit rate which they pay on people's deposits are still very low. That's why we are always like, hey, how come the interest rates go up, but then our money in the bank, the interest is still peanuts. So theoretically, this actually happens, right? So rising interest rates benefit banks. But if you see historically, right, over the past 10 or even 20 years, when we are actually experiencing a secular lowering of interest rates, banks continue to actually grow their profits, their revenues, their cash flow. So in Singapore, if you see, DBS it was earning about close to about $4 billion in revenues. But today, DBS as a bank, over the last 20 years, it has grown to about close to $15-16 billion of revenue. And this is an environment where interest rates keeps going lower, right? Back then, federal interest rates in 2000 was already at 5%. Today, what we are seeing is close to 0%, but yet banks are still making profits. So it's the same for even OCBC and even UOB. UOB back then in the early 2000s, they were just making about $1-2 billion of revenue, but today, you are seeing close to about 10 over billion dollars of revenue. So even in a low interest rate environment, banks can still continue to grow. So the key thing here, in reality, is that as an investor, I will look at coming down to a bit on the company level. I will look at the business model of these banks, what are their competitive advantages, and they basically how they actually make money over the long run. So I think that's actually more important than looking at interest rates alone itself.
But what do you think that caused that jump in the banking income? That you see, like you said, DBS was making about $4 billion and now suddenly go about $12-13 billion. But what was the factor that actually pushed that revenue higher?
Yeah, that's a very interesting point we should actually raise. If you see in the latest results for the past few quarters, or if you stretch out over the last 1-2 years, a lot of the profits are driven. The growth is really driven from the wealth business, especially in DBS and OCBC, because these two banks, out of the top three banks, DBS, OCBC, they have been focusing a lot on building the wealth business. So as a result, you see the growth really coming from these banks, our Singapore banks, trying to grow their wealth pie, trying to get more assets from the high net worth clients, not just in Singapore, but within the region and even overseas. So I think that has sort of led to a huge growth in their profits. Of course, rising interest rates has some benefits to their profit margins, but a lot of the growth is actually driven by wealth management, right? So if we see from some of their financials over the past few quarters, I think that has led to that kind of growth which we see, and of course to a huge share price jump for many of our financial stocks.
Right. So I mean, it's also like a chicken and egg story, right? Because rising interest rates will make money markets a little bit more interesting, especially that markets are a little bit shaky right now. So do you foresee, like you mentioned earlier, like most of the bank revenue comes from these wealth services that actually provide, because there's no point putting money in your FD, right? You can't make anything there. That's why people are investing. But do you think there will be a shift later on that if let's say the interest rates gets higher, that people will put more into a more safer bet, like fixed deposits or even the money markets?
Yeah, I think it is very hard to say this, but what I would say is that there's usually there's a huge lag between interest rates going up and deposit rates flowing through as well. And the reason why is because what I think is that in Singapore, at least, the deposit business is already well entrenched in the top three banks. So there's no reason why the banks in Singapore will actually raise the rates to be competitive. They can still pay a 0.3% on your savings account, or even less than 1% on your fixed deposit account, and they still won't lose the deposits of their customers, because there's no other way in Singapore where you can actually deposit your money, right? It's basically the three big banks or other licensed foreign banks who can take in deposits. So because of this, if interest rates go up, it's very difficult. I don't think deposit rates will also go up as well, or that much. With that being said, in a high interest rate environment, I think it will have little effect in how people will actually shift their money back into fixed deposits or back, at least into their fixed deposit or money market accounts.
Right. Okay. So last question about the banking sector. So by looking at the current scenario and the rising interest rates, and we know that the banking stocks, especially the three banks that you mentioned earlier, has already gone to historical highs, right? But do you think that this trend can continue at least for this year?
I think it's hard to say at this point. Number one, a lot of the valuation has been priced in. So if you see historically where these banks are trading at in terms of their dividend yield, DBS, OCBC, and UOB, they typically trade on average is about 5% dividend yield. But at this level, their yield is actually less than 5%. So which means that they are actually reaching to one of the most expensive dividend yield points, or they are reaching close to a historically low dividend yield. And a lot of it has actually been priced in. That means that people have already expected DBS, UOB, and OCBC to be growing by this amount over the next 2 to 3 years. So there isn't really much of a surprise, unless if let's say they have a huge unexpected profit, huge profits coming in. But the possibility is there, but the probability of that truly happening, I think that's hard to say. So I think a lot of the the value has already been priced into the market for this year, at least for the three banks. One catalyst for growth, which I'm seeing, it's really how, like I mentioned, how the three banks actually manage their growth segment in terms of wealth management, in terms of the digitalization of their banks. So I think these are the two key drivers which could very well actually affect the share price going forward.
All right. Thanks, Willie. Now, guys, if you have any questions for Willie, you can just type in down the questions on the comment section, and later Willie will be able to answer your questions there. Because this is actually a recorded session, so we won't be able to answer your questions live. But Willie said he will answer your questions in your comments. All right.
Yep.
Okay, so we are still in a topic of interest rates. So in your opinion, right, which sector in Singapore do you think that will benefit from the rising interest rates, and which sector would not be benefiting from this?
I think I would sort of divert from that question a little. What I would say in general, financial stocks are pretty good in the markets in rising interest rates. But what I'll also say is that I generally like businesses across the sectors in rising interest rates, but I'll be looking for really great businesses. So businesses where they can actually ride the tailwind of a growing economy. Rising interest rates in an economy is a reflection of a growing economy, a well-to-do economy. So if businesses can actually ride on that tailwind, I think that's generally very good. So I would pick businesses. I wouldn't be biased towards one particular sector, but I would pick very strong businesses which can actually benefit from growing economies. What I don't really like are sectors which actually borrow a lot, because I think that actually will affect the interest payment which they actually have to pay. For example, if you see sectors like utilities, right? Historically, utilities companies, they tend to borrow a lot. So in a rising interest rate environment, what's going to happen is that utility company will actually have to refinance at a much higher interest rate. But at the same time, many of these utilities company might not be able to revise their regulated pricing, because their regulated pricing tends to be revised every 5 years, 10 years. But if interest rates increase over the short term, what's going to happen is that they're actually going to pay more interest on the debt which they refinance. So higher interest rates means that high interest payment, which means less profits for some of these utilities company. Other sectors, which tend to overborrow or borrow heavily to run their businesses, I think this is something which I tend to be more careful and I'll tend to avoid.
Right. Okay. So do you think that with the expectation of rising interest rates, could that affect the GDP growth forecast of Singapore? Because at the end, it's still economic growth is the one that's going to grow businesses, right? But what's the economic or GDP forecast for Singapore for this year as compared to the previous years?
This one I'm not too sure, man. But I will know that in the recent quarter, I think Singapore's GDP has been growing pretty well. I think largely due to the fact that, number one, there's actually a shortage of manpower because of COVID, and number two, there's also a huge supply chain disruption. So the COVID pandemic over the last 2 years have actually pulled, while a lot of businesses like the F&B hospitality businesses have suffered, a lot of the other businesses in other sectors like finance have actually done very, very well. These are usually very these are very COVID neutral industries, and they've actually pulled up the general economy of Singapore. And as a result, right, a higher GDP growth also leads to high inflation, and that's the reason why what we're seeing now, there's a upward pull of Singapore's interest rates, and that's why also everyone's sort of jittery and pretty much concerned about it. So what I think is that I take it more optimistically. I think that it's a happy thing, because the economy generally is doing well, and the stock market usually reflects higher stock market prices tends to reflect growing economies.
Right. Okay, I'm gonna diverge a little bit on the interest rates. I think you have got that pretty much covered. And guys, if you want to find out more from Billy, you can actually just go to his website, dividendtitans.com.
Mm.
Am I correct?
Yep, that's right.
Dividend Titan, no S, Dividend Titan. I think we'll type in the comment section so that you can click on the link later, lah. All right. So I'm going to diverge a little bit from interest rates, because one of the other thing that's happening right now is the rising commodities prices, right?
Yeah.
And the Russia invasion of Ukraine has just brought up, just accelerated that commodities prices lah. So we look at even oil, even steel, right? Even like looking closer to here is crude palm oil prices has also gone through historical highs. It's like crazily
Yeah.
high. So with this rising commodities price, do you think there are any opportunities for investors to look at in Singapore?
Mm, mm. This is a good question. What I'll look at is outside commodities, and the reason why is because while commodity prices have actually gone up a lot, I can't say the same for many of the commodity companies on the ground. Say, for example, right, even though oil prices have actually hit above $100 per barrel, but it doesn't mean a lot of these oil majors like Exxon, Shell, or British Petroleum are starting to dig for oil again. Because a lot of them, they are still waiting on the sidelines on what's going to happen, because a lot of them have actually gotten burnt during the 2015 oil price crash. So they do not want to make the same mistakes again by investing in a lot of these greenfield projects, and then knowing that oil price is going to crash again and suffer the same fate. So what many of them are doing is actually they're all waiting on the sidelines. So you generally don't get to see a lot of huge capacity capex going for these oil majors. Having said that, what I will look at are companies which are going into the sustainable route. So going into the renewable energy, alternative energy, companies which are vendors or suppliers to companies which are in, say for example, solar cells, or even electric vehicles. I think these are ways where people can actually benefit or take advantage of rising commodity prices, because while commodity firms are not really going to invest in the commodity side of things, but a lot of the renewable energies, people are turning back into renewables because it's going to be very expensive. Commodities at the end of the day are actually huge input costs. Say for example, oil price. Oil price is a huge fuel cost for airlines. Nickel, for example, is a huge input cost for electric vehicles. So a lot of them, they're actually moving on to renewable or sustainable energy. And if you can actually find companies which are in that area, I think that's going to be one huge benefit or one huge driver in this growing commodity price environment.
Right. So we all know that the prices has been driven, of course, by this commodity super cycle that we have seen over the past few years. And of course, the Russian and Ukraine war has accelerated the prices further lah. I know this is a little bit out of the out of the topic, but do you think that the current commodities prices is sustainable?
Again, it's hard to say because it could be transient, and like what you said, the rise in commodity prices are really driven by geopolitical tensions. For example, the Ukraine invasion. I mean, if you see, Russia is one of the largest exporters of oil, and as a result of this war, they actually shot up oil prices to the roof. I mean, prices go up for fear of a shortage of supply. It very well could be like the COVID pandemic, where there's a huge supply chain disruption, leading to huge increase in electronic products. Products which are meant to be shipped overseas get stuck, and as a result, a lot of our daily essentials also go up. It could be transient, it could be temporary, where once things open up, for example, once the COVID pandemic subsides, things go back to normal, people get to travel as usual, prices could very well actually fall to normalized levels, even for oil prices as well. Once we get over the crisis or geopolitical crisis, we could very well see commodity prices, even oil prices, actually start to normalize.
Yeah, I think we got this a very perfect example in the glove makers during the early part of the pandemic, right? Where I mean, all of these companies, especially the glove makers, have got a really huge windfall for them, lah, right? But it was only temporary because the moment the vaccine comes in, and then everything now is normalizing back again, right?
Yeah,
So do you see that can also happen in the commodity sector?
yeah, it very well could. I mean, like what you said, Benny, I think the growth sector is a very good example. It's a prime example of what we are seeing right now. That is a huge rush in commodity prices because there's actually a lack, or there's a fear of a lack of some of these commodities. But when some of this crisis, or when the disruption sort of subsides, when things sort of go back to normalized levels, then we are probably going to see a much cooling a much cool off prices compared to what we are seeing right now.
Right, right. So we look at the other aspect right now, because you said that commodities can be a big cost for quite a number of businesses, right? So where do you see a business that could be impacted in its margins? If commodities prices, let's say, were to stay higher.
Mm. I think one of them is the airline company. I think the airline industry is going to take a huge hit if, let's say, oil price
Yeah, I mean
continues to go up.
they've already taken a big hit during COVID, right? I mean,
Yeah,
this is like a double
so
whammy.
it's going to be a double whammy, exactly. So the airline industry could potentially take a hit because of higher oil prices. I think another one is electric vehicles, where nickel prices have actually shot up. So nickel is actually a critical component to electric vehicle, to self-driving vehicles as well. And this could very well affect automobile companies, which are investing a lot in EV. So I think this is also one of the key risk which I see as a result from higher commodity prices.
Right. Okay. I think we got that covered. So I mean, because you have done research as well, and of course you are more well versed with the Singapore market. So moving forward in 2020, where do you see the opportunities are for Singapore now?
Yeah,
At least for
actually,
this year now.
yeah, actually, Benny, in the Singapore market, the two most popular sectors right now are banks and Singapore REITs. I think this is where the focus is, and this is where I will put my focus in. And partly because these two sectors are very well known for paying out dividends, so they are very, very good steady income drivers. And on top of that, like what we shared earlier, interest rates could very well benefit banks in the short term. And for very good Singapore REITs, it could also benefit from a growing economy. So I would actually focus on these two sectors. Of course, there are peripheral sectors as well, which are also very interesting to look at. I think number one is the semiconductor industry in Singapore. And the reason why is because I think there's this huge tailwind right now on the digital revolution. You have the Internet of Things, you have self-driving vehicles, you have data centers, you have cloud transformation. So everyone is all jumping on this digital bandwagon, and the COVID pandemic is actually a catalyst for it. So I'll actually look into some of the semiconductor companies in Singapore. I think this is one key area which I look at. Of course, on top of that, what I typically focus on, and also for my readers, is also to always emphasize, don't just look at the sectors as itself. Look for great businesses, collect great businesses that have growing revenues, profits, cash flow. For people who want income, then you probably want to look for great businesses which also pay out dividends consistently.
Right. Okay. Guys, so if you guys want to know, if you get more details on investing in Singapore, like I said earlier, we actually have a Singapore Trading Festival going on, and it's basically there are quite a number of experts over there, and Willie is also part of one of the moderators in one of the sessions there. If you guys are interested, it's a free online conference, so it's already done on the 26th or 27th of March. But we also have this weekend on the 2nd or 3rd 2nd or 3rd of April. So you go to the website sgtradingfestival.com. You can also take a look at all the agenda that's going to be up for this weekend on the 2nd to 3rd. So all you need to do is just head there and you can register, and they will give you details on how you can access to this online conference. All right. Okay, Billy, I think that's about all that we have for tonight.
Thank you so much, Benny.
We do hope to see you again probably in the next session, to talk about, we'll see maybe in the next 3 months or 6 months, see what happens, right? Then we'll be glad to actually invite you back again. And thank you very much also for joining us in this session. And once again, thank you so much. And we'll, hopefully that you'll be able to come back with us again in the future. And I also want to thank everybody for joining us in this session. Wish you all the best, and have a good week ahead. And make sure, if you're free this weekend, just join the Singapore Trading Festival. Thank you so much.
Thank you for inviting me, Benny. I enjoyed my time for this interview. Thank you, everyone.
All right. Awesome. Thanks.